in the UK. This is where the IEB gets its strength from internationally. The IEB is looked upon by government and regulatory bodies and sector bodies as being the standard setter for bookkeeping skills in particular, and also payroll. So when it comes to courses and qualifications offered in state-funded institutions, that's colleges of further education, adult education and training, the IEB is the one that has set the standards. For example, in relation to apprenticeships in the UK, which are for younger people, when they leave school and looking to be trained for industry, we were asked to develop the standards in bookkeeping and in payroll for those apprenticeships. The next, I've moved on perhaps a little bit quickly. I was going to talk about our international work then. The international work of the IAB is that we have members in 60 countries. We have courses running in more than 25 countries around the world. In particular, I want to mention the work we've done in Russia and Eastern Europe. We've trained more than 30,000 financial managers and accountants in those countries over the last 15 years, where they required to learn Western, if you like, bookkeeping and accounting. Indeed, until about probably 6 or 7 years ago, the IEB was the most well-known British accountancy body or related accounting body in Russia. These days, I think ACCA is probably as well known, if not better known than us, because they work with all the major audit firms. But in terms of foundations, it was the IEB that was asked to provide that training and qualifications to prove people's competence in producing financial records and statements to a certain level. Can I just check that everybody's hearing me okay?
Everything's muted there.
Okay, yeah, fine, thank you. I just wanted to make sure that everything's fine and people are hearing this okay. Very importantly, the IEB is a regulator of accounting service providers, a statutory regulator. Since 2007 in the UK, we've had much stricter anti-money laundering regulations. Any accountant or bookkeeper or accounting professional that offers services to clients, each of those have to be registered and they have to be monitored in terms of their compliance with the anti-money laundering regulations. The IEB is one of those regulators named in statute in 2007, and we regulate members to that effect. I also wanted to mention about our work with the Treasury, in particular in relation to anti-money laundering. We meet regularly with them on a quarterly basis. Her Majesty's Revenue and Customs are on 3 national committees to do with payroll, to do with what we call the agent strategy, to develop better ways of working between the revenue and the accounting and bookkeeping professionals. And also in relation to record keeping of businesses, the revenue has if you like, an inspection regime. It can go in and look and ask for all the financial records of businesses, and we are working in partnership with HMRC to improve the standards of record keeping in businesses. We also have key collaborative partnerships. We work very closely, for example, with the sector body for training in our sector. That's the Financial and Legal Skills Partnership. We also work very closely with the Chartered Institute of Payroll Professionals. They're very good friends of ours. We work closely with them, and particularly with the small business community. In fact, our own chair, the current chair of the IEB and the International Association of Accounting Professionals, is a lady called Janet Jack, She has her own bookkeeping and accounting service business, and she's also the national treasurer for the Federation of Small Businesses, which is the largest organisation in the UK representing small businesses. Going on to the next slide, it perhaps goes without saying now that you know a bit about the IAB. It's a membership body comprising actual bookkeeping and accounting professionals, and it's an employer monitoring body, supervisory body. Our qualifications that we design, therefore, are all based on the professional skills of those people and their knowledge of the workplace and what is required. We get our strength from that. That's what the IEB and the IAAP are now well known for, and our qualifications are always relevant and up to date, and they're not simply ones created by an education body. Moving on a little bit further down, conscious of time here, I think it's important to understand that the IEB's qualifications are recognised by the Institute of Chartered Accountants in England and Wales, the ACCA, CIMA, CIPA. Those are our level 3 and our level 4 qualifications, which are recognised for both entry and for exemption. The IAAP, we have a high national diploma jointly with the Scottish Qualifications Authority. That is granted 6 paper exemptions by ACCA and 5 by CIMA. Also, IB qualifications are not only recognised by universities for entrance, including the University of Northampton and others, but also some universities include our qualifications within the undergraduate programmes in order to give undergraduates vocational skills, recognising the weakness, if you like, of pure academic training or study of accounting. Final bullet point on that slide is our external accreditation and certification services. We've worked for many years providing this, so this is where employers or particularly overseas institutes and training organisations, they approach IAB and IAAP for us to quality assure their own internal courses that they provide. Bring quality assurance to both the syllabus, to the assessment standard, and to sample their assessments and to certificate their students, which is that bringing that externality, if you like, to the courses of these training providers. Okay, on to the next slide, please. Thank you. Quality assurance. I've already talked about the first point in terms of IEB professionals designing qualifications, and therefore people have the assurance that they're actually up to date and relevant. The setting and marking of assessments are overseen by examiners and moderators, and that final bullet point on that page, you have the assurance, everyone has the assurance that IEB is regulated by the government's regulator in England called Ofqual, and Ofqual regularly monitors awarding bodies, and at no time since we were approved and regulated have there been any allegations or indeed any findings of malpractice or maladministration. Our systems have all been confirmed to be fit for purpose. Okay, if you want to go on, thank you. Just a couple of slides now on the IAAP. IAAP was recently established, and we did that because the IAAB's name is associated in people's minds with perhaps lower levels up to what we call level 4, which is the first year of undergraduate study. And the IAAP is to enable qualifications and recognition at a higher level. So, for example, the High National Diploma goes through to the second year of degrees and progression opportunities to the full bachelor degree programme. And also recognising that we want to facilitate further qualifications internationally in accounting. Okay, on to the next slide. I've already mentioned about the Financial Business Management Higher National Diploma, which is widely recognised by ACCA and CIMA and over 40 universities for progression to full degrees and MBA programmes. We've got this range, as you know, of IFRS qualifications that we've launched in India, and also beginning to get interest from other countries, in fact significant interest from other countries. And we have our own membership and fellowship qualifications which are in development currently. Okay, and I think there's one more slide, is that right? Or was that our final slide? No, that's the final slide. Thank you very much indeed for your attention. Yes, use the mic. Okay, me. Do I need to?
Thank you. Hello, good evening everybody. This is Dr. Gopal Sharma, this side. So as part of this meeting, I am going to brief you how this convergence in India is to take place. See, when we talk about the convergence from the current Indian accounting standards to international financial reporting standards, see, there is a crystal clear pathway which is given to all of us. We must understand the current style of recording all the transactions in the books of accounts, and we need to understand the requirement of the international financial reporting standards. The basic element what we have to understand in this case is, at the transactional level, there are no clarity issues. Things are going to be absolutely fine. But when it comes to certain presentations, certain communications, certain calculations, things are going to take a different shape as far as international financial reporting standards are concerned. Now, in order to give you a nutshell of how this presentation has happened as per this international financial reporting standards, I am going to give you a comparison of the statement of profit or loss as what we follow in India right now, and how the same is to be presented going forward as per IFRS. The statement of profit or loss for the year ended, which is known to most of you, will be having so many elements which start from the sales. The sales will be further broken down in terms of the taxation which is imposed on the products, then the sale revenue which comes from, or the revenues which comes from the services, and the income which comes from other activities of the business which are not directly related to the business operation. So all these elements put together, we consider here in India as the revenue. And we have one more set which talks about the total expenses during a particular year, which includes the cost of the materials consumed, purchases of stock in trade, and the changes in inventories and the finished goods, work in progress and the stock in trade. Then we have this employee benefits. Then we have this finance cost, which is nothing but the interest. Then we have the depreciation, which is charged on various tangible assets, and the amortization of various intangible assets. And this other expenses includes other administration expenses and the selling and distribution expenses. So the breakup of all these expenses together, we can find out the total expense for the particular year. When you reduce this total expenses from this total revenue, we will be getting this profit or loss before tax. There are certain exceptional items which are not directly part and parcel of the business operations, which are categorized separately in India. Then you will be arriving the profit or loss before tax. Then you will be charging the taxation to arrive the profit for the year. This is the normal way by which we present the statement of profit or loss in India right now. When we move on further, in terms of the requirements of this international financial reporting standards, we refer this particular element as the comprehensive income statement. This comprehensive income statement as such has two parts. One is profit or loss part. The next one is other comprehensive income part. This profit or loss account part, which represents the core operational profit, whatever emerging during a particular year, comprises of, again, the revenue from sales operations, or if it is a service-based organization, it will be revenue from services. Then, any cost of sales, whatever the cost which you incur directly for generating this revenue, will be straight away reduced from this sales or the revenue to arrive at the gross profit. Then the other income is separately added to this gross profit. So we will be getting the gross income. From here we will be reducing this distribution expenses, otherwise referred as selling expenses, the administrative expenses, finance cost, and you will be arriving the earnings before tax. Then the tax expenses for the year will be reduced to receive this profit for the year. Then comes the other comprehensive income, other comprehensive elements part, which comprises of the elements which are not in reality part and parcel of the regular business operations, but which are to be considered as part of the statement of profit or loss account to arrive the income for a particular year. Such kind of elements like this revaluation gain, revaluation losses, exchange gain, which normally occurs in the case of transactions, or the losses which are arising as per the same level of transactions. Then the actuarial gain or the losses as part of this defined benefit obligations from the employees. All these elements are not exactly related to the business operations during a particular year, but need to be considered before arriving this profit or loss account for the year. So, all these abnormal, I can't say it is abnormal, all these elements which are above the normal regular operations are categorized under this other comprehensive elements, and every element which are forming part of the regular operations are categorized under this profit or loss part. Now, the most important part to be understood in this case is, I am just going to give you an example of this cost of sales. We have in India the concept of the cost of goods sold. If you go through this Indian style presentation of statement of profit or loss, till now, the concept of the cost of goods sold, which comprises of the cost of the materials, purchases of stock in trade, and the changes in the inventory. These three are referred as the cost of goods sold. But in IFRS, we are considering the concept of cost of sales. See, when we are converging from this Indian style of accounting or Indian style of presentation to the required presentation as per the international financial reporting standards, from this cost of goods sold, how we are calculating the cost of sales needs to be understood very clearly. See, as in the case of this cost of sales, we have this cost of goods sold. Over and above this cost of goods sold, we have certain other components as well, like this cost of distribution, nothing but the right component, whatever we distribute the goods to various customers. Then that depreciation, amortized expenses, loss on sale of tangible and intangible non-current assets, research expenses, and the non-capitalized portion of the development expenses, everything are considered as part of cost of sales. 20% the same as per IFRS. When we are converting from the Indian style of presentation to IFRS, the cost of sales as a concept is taking a different shape altogether. Whatever we were categorizing under different heads need to be clubbed together to include the same under the head cost of sales now. For example, I will explain this cost of distribution, that is price. in India, we are considering it under other expenses in the income statement. Why? Because other expenses in India comprises of the selling, distribution expenses as well as general administration expenses other than employee cost. But the cost of distribution, that is the freight element, we are removing it from this other expenses and bringing it over or under the head cost of sales as far as IFRS is concerned. Similarly, selling commission, another element of cost of sales. In India, when we present the statement of profit of the same is included under the head other expenses. Depreciation in India, we are presenting it as a line element. It's a different head which is presented while we communicate the profit or loss account in India. The depreciation is again brought under the cost of sales. See, the depreciation, why we are considering it under cost of sales? I will explain this later. Similarly, amortized expenses which are related to the amortization of intangible assets, we are bringing it under cost of sales in IFRS, whereas in India, we have got a separate head to present the same as part of the profit or loss account. Similarly, the losses which might arise on the sale of tangible and intangible non-current assets, that's the fixed assets. When such kind of losses arise, in India, we will be taking as part of this other expenses, but in IFRS it is going to be part and parcel of this cost of sales. Similarly, the research expenses and the non-capitalized portion of the development expenses we include in India under the head other expenses. In certain cases, we will be including it under administration expenses in India as well. Such kind of expenses are comfortably categorized under cost of sales. See, the concept what we have adopted in considering all these elements under this cost of sales is mainly because of the fact that all these elements are having a direct link towards generation of the revenue. Earlier, when we talk about the concept of the cost of goods sold, the cost of goods sold will be comprising of the opening stock of all inventories, the materials consumed during the year, or any purchase of the stock in trade. Any direct expenses involved in purchasing such kind of stock in trade, reduced by the closing inventories will be giving you the cost of goods sold. See, to arrive this cost of goods sold, we are considering only the direct expenses related to the procurement of the goods. But in the case of this cost of sales, we are building upon further from the concept of the cost of goods sold to include various elements which have a direct link towards this revenue as well, which is missing in India. In the case of cost of goods sold, we are only considering the direct expenses related to the procurement of the materials, whereas in the case of cost of sales, we are considering not only the direct expenses related to this procurement, we are also categorizing certain expenses which have got direct link towards the sales. So, cost of distribution freight has got direct link towards the sales, without which no realization of the sales is about to take place. Second thing, direct selling commission is to ensure revenue for the business. Without the selling commission probably, you may not be able to generate so much of revenue what you have booked right now as per the profit or loss account. And because of this reason, this has got direct link towards the revenue. Then this depreciation. Without this, no production happens. Without production, no sales. Without sales, no revenue. So depreciation is again related to sales revenue. Amortized expenses, which are related to the portion of the intangible non-current assets, again are treated as directly linked to revenue because the same concept of this tangible non-current assets, the depreciation is applied in the case of amortized expenses as well. And same is the case with this loss on sale of tangible and the intangible non-current assets, which would have been helping you or which were helping you in the business for generation of this revenue. Similarly, the research expenses, development expenses, everything have direct link towards this sales. Hence, you are bringing it under the fold of cost of sales. IFRS standard says very clearly, even though this is a general guideline for inclusion of all these elements under the head cost of sales, IFRS says very clearly, as per the management policy or the accounting policy of the business, they have got the discretion to delete or include certain expenses which they feel, which has got direct link towards this sales revenues or revenues of any business in the prices. This is one of the most important prominent differences which I would like to bring to the highlight at this forum. Similarly, when we go through each and every element, like your administration expenses, distribution expenses, the treatment of the finance cost, how do you compute the depreciation in practice, the concept of the component depreciation, all these elements are going to be differentiated from the style whatever we follow in India in terms of the international financial reporting standards requirements. So, similar is the case of the financial position, that is the balance sheet. When we present the balance sheet, even though the presentation looks similar, contents are going to be different, the treatments are going to be different. So, the convergence at each level, each point of transaction, we need to give a different meaning when we move from the current Indian style of accounting to the international financial reporting standards. So, a slow convergence is the way to move further